Lynnette Khalfani-Cox, the Money Coach. I'm the CEO and co-founder of AskTheMoneyCoach.com and Money Coach University. If you're in the market for a loan, chances are lenders are going to assess something called your DTI, or your debt to income ratio. But what exactly is a DTI, and how can you improve it in order to get approved for that loan that you want? Well, first of all, you need to understand which debts are taken into account when a lender is telling you whether or not they're going to approve or reject you for a loan. The debts are typically anything that's included on your credit report that you have 9 to 12 months or more to continue paying for. So let's say you have credit card debt that is still remaining and still has to be paid off. That's going to be counted in your DTI. Let's say you have an auto loan and there's still a year or two more to pay off that car loan. That's going to be counted in your DTI. What about student loan debt? Yes, if you haven't paid off those college loans, that will also be included in your debt to income ratio, or DTI. Lenders take a look at all your monthly payments on the credit standpoint, not the other stuff like your utilities or maybe child support payments that you have to make, or your water bill or your internet connection, all that stuff. That does not go into your debt to income ratio. It's only those debts that are reflected as traditional credit obligations on your credit reports. So they'll add up all of those on a monthly basis, and that's going to show them your monthly minimum debt payment that you have to make. Then they're going to take a look at your income, and they're going to take a look at your net income typically. So they're going to look at your paycheck and any sources of income that you have. Maybe you actually receive child support payments. Did you know that you can actually include that in your income calculations when a lender is looking at you and deciding whether or not to extend credit? That's true, you can. But what about some other things? You might have commissions in addition to your wages. You might have rental income, and typically you have to have it for 2 years or more in order for a bank to assess that and to use that in your income consideration. So they take a look at all of your sources of income and they total it up. They divide it, if it's annually presented to them, they divide it by 12, and that's how they come up with a monthly figure. So they ultimately compare the debts that you've shown. Let's say they were $3,000 a month, and they look at your income, and let's say it's $9,000 a month. Then they'll say, aha, this person has $3,000 a month in debts, $9,000 a month in income. Their debt to income ratio is 33%, because your debts represent 1/3 of the income that you're bringing in. So when you're looking at trying to figure out your own DTI, what you need to understand is what's going to be assessed, what's going to be counted. I've shared with you what banks typically do, and this is the case if you're looking to get a mortgage, for example. Lenders will look at something called your front end DTI as well as your back end DTI. So that back end DTI will include your housing costs as well. So they'll add in everything like your mortgage payment along with those other credit obligations that I mentioned before. So you should ask your lenders when you're in the market for a loan, what is your limit or your DTI policy in terms of the highest level of DTI or debt to income ratio that I can show and still qualify for this loan, for this mortgage or whatever else it is that you want to get. Typically for mortgages, most lenders are somewhere in the 45% figure in terms of your overall DTI or your debt to income ratio. They're going to look at your housing payment, your credit card payments, your student loan payments, your auto loan, and they don't want that figure to be more than, say, 45% of your overall monthly income. Now, some lenders, of course, will have more strict guidelines and others will have more liberal guidelines. You might find some saying, nope, you can't go past 43% debt to income ratio, and others might bump it up to as high as 50% in order to be more liberal in their underwriting standards. But it's up to you as a consumer to first ask so that you know ahead of time what to do. Maybe you need to pay off some of those debts before you actually apply for the loan. But at least you understand now exactly what a DTI or a debt to income ratio is.